Howdy, Jacob here. Today we're looking at Keurig Dr Pepper. I'm sure you've heard of it in the beverages industry. 39 billion market cap on 49 billion enterprise value. So a little bit of net debt here. Founded in 1981. I'm not gonna lie, that was later than what I thought it would have been. I thought it was more so like maybe not as early as Coke, but um, you think about it: Coke, Pepsi, DP. Uh, Revenue growth 6.1 billion in 24 to 14.8 billion in 2023. So a good amount of growth, not as substantial as some of the ones in our ROIC screener, but still very consistent growth here. You like to see that. I wonder if these big jumps are likely due to acquisitions and such. But return on invested capital, looks like I'm assuming there was an acquisition between 2018 and 2019, and that bumped down their return on invested capital quite a bit. Let's see. Yep. So 2018, a $19 billion acquisition that they funded through issuing shares and issuing debt. And it kind of cut their ROIC a bit, but um, yeah, that's tough because before that, earnings were pretty fantastic, upwards of $6 a share. And then when they purchased the company, they 60+% of their revenue, but their earnings per share fell very heavily. So I wonder if they can possibly get back to these margins. You wonder if just the business they had prior was, could perform this, and then the one they bought just gets back to budget neutral, and then you look a lot better. Your ROIC is still going to be hit though, because the acquisition that you made has increased your balance sheet, assets and shareholder value on your balance sheet. So that affects your ROIC calculation. But let's start looking at that balance sheet. We saw a little bit of net debt here. So we do see that definitely. 267 million cash on hand on a good amount of debt here. 13 billion short-term and long-term debt, with 3 billion on the short-term side. That is a little bit concerning in the fact of, I mean, they don't make enough and don't have enough cash on hand to be able to pay that off in 1 year. So they are forced to refinance that debt. And that's just tough. I mean, they've been consistently buying down debt, paying down debt, which is nice since that acquisition. They went from 4 billion to 14 billion back, and now they're down to just under 10 billion. But you got to think about when that debt's due, and we see 3 billion due in the next year with 267 million cash on hand. That's a little bit concerning to me. Their use of money and free cash flow is very consistent on the um, acquisition side. They buy a lot of companies. They purchase a lot of companies. Recently, they've been buying back a lot of shares, and then they've been paying a dividend that's fairly substantial. And in fact, in the most recent rolling 12, it's greater than their um, free cash flow of the rolling 12. But on a 5 year average basis, it's still about 50%. So you might think that it is, pretty fine, but I think that dividend's fine. I'm not worried about it, but I am worried about that debt and how much debt they have due soon. You're gonna have to figure out really how to pay that or refinance that. So let's start making some assumptions here. Again, we don't take into consideration the balance sheet, so you're going to have to balance out your own discount rate or balance out some of the assumptions you make, saying that they might grow less because instead of reinvesting back in themselves, you're going to have to go to pay down this debt. You're going to have to take that into your consideration. I'm going to do what makes the most sense to me, and I think growing above inflation due to acquisitions seems to make a lot of sense to me. I think inflation is going to be 2 to 3% likely over the next 7 years, or per year for the next 7 years. I think they'll do slightly better than that due to increasing their products at that inflation and then also acquiring companies. I think that share change 1% would be about 400 million, and in relation to cash flow on a 5 year average basis, that's about 20%. But historically, they haven't repurchased too many shares. So maybe I'll say they repurchase, 0.5% of shares a year over the next 7 years. The P, price to free cash flow in this company, I think they have. I don't think they have nearly the mode of a Coke or anything, but I think that they just have so many products. They're probably similar to a Pepsi, and I really don't think that they're going anywhere. I would say that, um, I mean, they do have the Mountain Dew brands, which are very popular. Did I misread that somewhere? Okay, I might have misread that, but I thought. Okay, yeah, misread that. Never mind. It must be Pepsi or Coke, but they have so many brands: RC Cola, Hawaiian Punch, Squared, Sundrop. I could see them, having somewhat of a mo in that business. Do they really? Um, that's just what I'm going to assume right now. 15p price for cash flow, relatively in line with the average of a company. And then for margins, let's see, we are going up, which is nice. Um, we are moving up in the margin side, so that is good to see. 12, 17. I also really like that free cash flow margins a lot higher than earnings margins on average. So let's do 14, 18. And then on the dividend side, I want them to keep that flat because I want them to focus on paying down that debt. So they'll have, even with them purchasing 0.5% of shares, paying this dividend, and then making some acquisitions, they should have at least 25% of their free cash flow going towards paying down that debt, which you really want to see this company paying down some of that debt, especially some of the more recent debt or that high interest bearing debt. That could absolutely affect the business, and we don't take it into consideration here. So, based on my valuation, I think that it's just still a bit expensive here. I think that the debt kind of turned me off a little bit. Not saying it'll entirely turn me off. I think if I do more research on the company and what their debt situation looks like, then maybe they'll be able to refinance it very, very easily. No worries. But for me right now, just slightly out of the range. So hopefully you enjoy the video. Have a great rest of your day. Thank you.